Today, we're talking about investing. So here's a question. Dear Kat, I'm 40 years old. My wife and I are pretty risk averse. So far, we have invested in a couple of properties, but the returns are not what we expected. And it's been difficult to find tenants for the long term. Besides, my wife complains about dealing with tenants and managing the properties. Our friends asked us to consider investing in the UX stocks, but we are worried about the risks involved. Do I really need to invest in the stock market? Well, you can invest in anything you want. And I understand the attraction of properties. It's a tangible asset. You can feel it, you can touch it, you can even hug a pillar. That gives people emotional comfort, especially if you've lived there for like 20 years, you know the location. So even if the price goes down, you will say that, oh, I'm not going to panic. This is a good location. The price will come back up sooner or later. But how do you know that? That's because you know the track record of the location, right? So the same thing with the US stock market. But how much growth can you expect from properties? Let's say you buy a 1 million property today. How much do you think it'll be worth in 10 years' time? In Malaysia, we have a problem of oversupply, especially in condos, which keeps the prices low. And besides, it's quite difficult to find good tenants who can pay you on time. Not even talking about property management, that's another area to look at. Now let's take a look at the US stock market. It is where the biggest and most profitable companies are listed. In a study published by Aswath Damodaran, professor of finance from the New York University, stocks gave the best return over time compared to other classes of assets, not including Bitcoin, okay? If you had invested $100 in 1970 in stocks, by 2023, it would have grown to 22,419, as measured by the S&P 500 index. 7,775 if you put it into corporate bonds, 5,545 if you put it into gold, 2,286 if it's in treasury bonds, 1,542 if you put it in US real estate, and 956 if you put it in cash. So if you're serious about growing your wealth, you can't afford to ignore the US stock market. The Standard & Poor 500, otherwise known as the S&P 500 index, is a proxy for the market. It grows by an average of 10% per year. Investing in the US stock market means that you are harnessing this 10% compounding growth rate into your portfolio. But wait, what about people who think about the market as a big casino? When you were younger, maybe your mother told you about Uncle Pete, who lost everything when the market crashed. So that stuck in your mind. Uncle Pete lost everything. The stock market is dangerous. Well, it's true. If you don't know what you're doing, you can lose your money. What is the stock market anyway? It is an exchange where people can buy or sell shares of companies listed on the exchange. By the way, shares and stocks are the same thing. We Malaysians use the term shares, Americans use stocks. They are the same. Hey, if you like what I'm sharing, please like and subscribe. Take Nvidia as an example. It is listed on the Nasdaq. Nvidia is estimated to post a revenue of $130 billion for its latest financial year. Nvidia is a very valuable company. If you buy one share of Nvidia, that means you are one of the owners of Nvidia, although a very, very small one. If the market is made up of companies like this, how can it be a casino? Just like properties, it has a long track record over time. The S&P 500 grew by 81% over the last 5 years. Having said that, some retail investors do treat the market like a casino. Remember Uncle Pete, the one who lost his money decades ago? Well, he got back on the horse. So during a recent Chinese New Year gathering, Uncle Pete comes up to you and tells you, "Psst, I've got a stock tip for you. Guaranteed to make money." Now, if you take Uncle Pete's tip and buy the stock without doing any research, then that's gambling. You don't know what the company does, what its revenue, what its profit are, and you don't know what its earning forecast is. You may lose all your money. So after listening to me, you decide you want to invest in the US stock market. But how do you go about it? There are two ways to invest in the stock market. The first one, do it yourself, DIY. The second way, outsource it. Okay, if you choose the DIY method, please don't be stingy. Pay money to learn. Learn how to identify good stocks, know when to enter, when to exit, how to put a stop loss so that you don't lose all your money, how to calculate the risk and reward of every trade, how to calculate how many units you can buy. So it doesn't mean that if you have 10,000 to invest, you dump everything into Nvidia. If you did that, then may the GPU be with you. Nvidia sells GPUs, by the way, in case you didn't get the joke. Now, I'm not selling any stock investment or trading courses here. If you want to learn, please check out my affiliate link with Beyond Insights below. I studied with them. Excellent people there. If you use the link, you will get a discount and I will earn some money. The second method, outsourcing, is a do-it-for-you method. That's where I come in. It's very suitable for people who are totally not interested in learning how to invest, or you are just too busy. You have no time. You work long hours, and any free time you have, you want to spend with your family. You want to go hiking, you want to go swimming, you want to go play golf, anything except spending time to learn investing. Well, if that's the case, this solution can be for you. You outsource the investing to me. I help my clients to invest in US mutual funds issued by top asset managers like JP Morgan, BlackRock, etc., using saving plans from global insurance companies, all above board and approved by our authorities. I'm not a fund manager. I'm a licensed financial advisor who acts as your portfolio manager. So what's the difference between the two? If you invest, let's say, in US technology fund, the fund manager's role is to every day decide, okay, which company should I invest in? Which company should I sell? For example, shall I buy more Meta? Shall I sell Nvidia? What price are we doing that? And when to do that? That's a fund manager's role. As a portfolio manager, what I do is to help my clients to pick high-performing US mutual funds which beat the S&P 500. About 80% of my picks would be funds that actually beat the S&P 500. When the market is down, I need to decide, is it a pullback or have we entered into a bear market? Now, the stock market doesn't go up like a rocket. I wish it does. But in the short term, it goes up and down. So if it's a pullback, it can mean that it's just the market taking a breather from a rally, or there is temporary bad news. So for a pullback, I won't do anything. But if it's a bear market, then I will pull all my clients' money from funds and put it into a money market fund, which is like a fixed deposit. And we take shelter there until the market recovers and I reallocate the funds again. This strategy is to minimize the chance of making a loss and also to optimize my client's capital. I know I told you that there are two ways to invest, but actually there are three. And the third way is probably the best one. It's a hybrid of the first two. So you go and learn how to trade and invest, but you can't be an expert overnight, right? So while you're learning and practicing, you can put some money into the US mutual funds so that your money can start working for you straight away. Now, I'm not telling you to sell all your properties and dump all your money into the stock market, okay? No, no, no. But you can diversify and earn a better return for your portfolio. See you in the next video.